Are UGMA UTMA accounts better for financial aid? Imagine trying to save for college and wondering where to put your money so it doesn't hurt your chances of getting financial aid. That's a question many families ask when planning their investments. Today, we're going to look at whether Uniform Gifts to Minors Act and Uniform Transfers to Minors Act accounts are the best choice for this purpose. These accounts are set up in a child's name and managed by a custodian until the child reaches adulthood. They are flexible because once the child turns 18 or 21, depending on the state, they can use the money for anything. But that flexibility comes with a catch when it comes to financial aid. When applying for financial aid through the Free Application for Federal Student Aid, or FAFSA, the government considers these accounts as part of the student's assets. That's important because student assets are assessed at a rate of about 20% of their value each year. So if you have $100 in a UGMA or UTMA account, the student is expected to contribute $20 toward college costs annually. In contrast, parental assets are only assessed at around 5.6%. This means that money in a custodial account can significantly reduce the amount of need-based aid a student might qualify for. Now, these accounts do offer some advantages. They give the child control over the funds once they reach the age of majority, which can be helpful for teaching financial responsibility. They also allow for broad use of the money, not just for college expenses. However, because of how they impact financial aid, many families prefer to keep these assets separate from college savings plans. One strategy some families consider is transferring money from a UGMA or UTMA account into a 529 college savings plan before applying for aid. A 529 plan is treated as a parental asset, which means it lowers the expected contribution rate and helps preserve eligibility for need-based aid. But it's important to do this carefully. The transfer must follow custodial rules, and the account must be in the child's name, with the custodian acting as the owner until the transfer is complete. In summary, if your main goal is to maximize financial aid eligibility, UGMA and UTMA accounts are not the best options because they increase the student's assessed assets. Instead, 529 plans are more favorable because they are considered parental assets, which have a lower impact on aid. Still, these custodial accounts can be useful for other reasons, like giving your child control over their savings or for flexible spending. Balancing these factors and planning ahead can help you make the best choice for your family's financial future.